Well, good morning, everyone. Here's another episode of the Three Amigos. Today, we got the pleasure of listening to Ed as he speaks a little bit about maintaining or putting in internal controls that will help you eliminate fraud and some other things. Ed, I'm excited about seeing this. Without further ado, take us away.
Well, thank you, Ray. One of the principles of good business from a financial perspective is having a system of internal controls in place so that things happen the way they're supposed to happen and there's no surprises. I think that's one way of putting it. And it keeps everybody honest, focused, and moving forward. So today, I'd like to talk a little bit more about financial internal controls, but I'm also going to tie them into what we normally talk about is adding value and reducing risk. That's kind of what consultants do with companies. And I think internal controls are a great way of making sure that you're on targets. So I would like to start off with kind of a general definition of what an internal control is. And it is basically a system designed and maintained by the company's management and top level executives to provide a substantial degree of assurance in achieving business objectives while complying with policies, laws, safeguarding of assets, maintaining efficiency and effectiveness, and the reliabilities of the financial statements. Now that says a lot, and there's a lot there, but if you look at some of the key components, it's a system, a process. That's what you run all companies by. And you want to make sure that things are going well. So you don't want surprises in running a company. And you want to make sure that your record keeping, which is your key indicator of how well you're doing, is reliable. And I think we've worked at some companies in the past where they didn't have reliable financial statements. And it's very, very difficult for consultants to add value if they're not seeing accurate and timely financial statements. So I'd like to get a little bit more into the connection between financial controls for financial reporting as well as controls for running a business. I think there's a lot of parallels and a lot of benefits for both. So here's 9 factors. The first one is define processes and procedures. Well, we've learned in valuing businesses that can be the special sauce of a business. How well they do what they do. How accurate is that process? Does everybody know what's going on? That's really important. So controls can be a big value generator for the company. The second one is another one we talked a lot about, and we've seen it in action where we rely on one person to do everything, and there's no checks and balances. The principles of the business really aren't checking the detail. They have a trusted employee that does everything, and there's no checks and balances. And that allows that person to get off the reservation. It hurts performance because if they're not doing their job, no one's going to know about it because there's no check and balance on that person. And normally, from a financial perspective, the people that do the record keeping don't have access to the assets, because if you'd have both, you've got a bad situation going and you could get ripped off very easily. But I think that rather than being ripped off with fraudulent activity, I think the biggest problem with not having a segregation of duties is that you just don't have accurate information and you're just not running the business on all cylinders.
Can I ask you a question, Ed? And
Sure.
You can defer this till later if it kind of gets in the way of your presentation. I'm thinking about small companies that don't have enough people to do that, and how you deal with that. For instance, it's nice to have accounts payable and accounts receivable people different than each other, two people. Any ideas, or maybe add that in at the end as you
Well,
wrap it
I
up?
think it's worth noting because I think with internal controls, it's dependent upon having more than one person, correct? Because if you only have one person doing everything, it's pretty hard to have segregation of duties. So what I think the way to get around this, if you have a controller that's pretty much doing everything, I think the business owners have to take time in reviewing what that person is doing. They need to be signing the checks. They need to be looking for support. They need to be double checking the accuracy of the reporting. And I think having an audit, some type of audit at the end of the year or review is really important to keep everybody.
Maybe using outside people occasionally to
Yeah, I think so, but it's a real problem because as we all know, when you're running a business, you tend to have loyalties to people and you give them the keys of the kingdom, and then you take no responsibility for checking their work. And then when there's a problem, everybody says, "Oh, I wonder why that happened." Well,
that happens, I think, based on our experience, that happens a whole lot more than an individual business owner thinks it does. And therefore, they feel artificially safe when it's really not true, that it just happens a lot. Would you guys agree with that?
absolutely. Absolutely. And the other problem you have is when you find a problem, you got to point it yourself. So what ends up happening, everybody tries to hide the problem. Okay, so let's say you found somebody who stole $12,000 during the year. A lot of times, rather than admitting it and prosecuting the person, they pretend like it didn't exist, or they move on to other things, and there's no accountability there. So when there's a problem, when there's fraud, people don't want to report it.
Yeah, I
I
think
don't know if you've
that's
seen
an
that in
issue
your
too.
careers or not.
Yeah, it seems like, because we have loyalties to people and, we can't believe they did it. But on the other hand, do we want the bad press that comes from, accusing somebody of fraud and all the stuff that goes with that? So, yeah, I agree. It's very hard. And people tend, in small business in particular, I think we've all experienced that their loyalties tend to be misplaced many times. And I've talked with so many guys who've had that challenge.
Yeah, that's a very good point. And I think it comes down to, from my perspective, and maybe it's kind of the way I'm wired because I'm a financial person, when you find something like this, you have to deal with it. You can't hide it, and you have to deal with that person. And if they're unloyal and dishonest at one point in time, I don't think you can rely upon them changing their behavior. And I think you have to get rid of the person, and you have to bring a new person in that place, and move on from there. I'm pretty serious about that. I think that's really important. Otherwise, you're perpetuating the problem.
You're absolutely right, Ed, and I would completely agree with that. If you don't like making those kinds of decisions, you really don't belong in business, because it'll catch up with you one way or the other. The other side of that is, as we learned in one of our recently previous shows, that if you have several people who are allowed to get away with things and cheat in one way or another, that you're going to have as many people see that and copy that behavior. And therefore, every time you leave one in place, you've got one more now who's copying the first one. So you've got, if a third of your people are dishonest, you've got another third of your people who are also dishonest, and will steal from you. So it's a downward cycle. It's got to be nipped in the bud right from the beginning. Keep everybody honest and fair, and that's what's honest and fair.
And business owners have to take the time to review what's going on. They can't totally delegate it to someone when there's no checks and balances on that person. And I think a lot of business owners, that's what, once they have that loyalty in place and that trust, they just let that person go, and they don't follow up. So that has problems. But I think with controls, I think controls are primarily associated with fraud, but the real value in controls is how it helps you run the company. And number three is improved performance and efficiency with standardized processes. And you look at any type of valuation book, it'll tell you how important it is to have efficient and performance based upon standardized processes. That's really, everybody knows what they're supposed to do. And when they go to work every day, they follow the playbook and get it done without exceptions. And that's what controls make sure happen in a business. The other thing, you want to mitigate risk, and you look at the risk of a business from the beginning of a business to the end of a business, all the different process. What are your material risk of not meeting your objectives? And you put in your controls to protect those assets and reduce that risk. Reducing errors is a big deal, because if you have fewer errors, you have more efficiency, you improve accuracy, quality, and customer service. Errors are a hindrance to running a business, and they most of the time have a negative impact on your customers, which obviously we feel that the customer is number one, and that's why you're in business. So obviously you need to reduce your errors. You have to have accurate and timely financial statements. And unfortunately, we've been involved with some businesses that didn't, and it's really hard to help them improve if you don't know what's going on. And the other thing is, you don't want surprises. And when you see a company that's constantly making all kinds of correction entries based upon cleaning up past messes, that's not a well-run company, and that's a real flag for fraud and other problems, primarily not knowing how well the business is doing. So we've talked about in previous shows how important and accurate and timely financial statements are, because it's really your official report card with your employees, your ownership, and customers, as well as bankers, which makes a big difference.
You know, Ed, I just was asked the other day by somebody who I had met who was new and was interested in business. And we were talking about microgiants, and he asked me a question I had to think about. It's like, well, what's the primary thing you try to teach your small business group, microgiants? And I thought about it, and I thought, you know, primarily what we're about is teaching them to deal with reality. In other words, they have to be able to reason accurately. If you don't have financial statements that are accurate, you cannot be reasonable about it.
Absolutely. I mean, you're shooting in the wind. I mean, it changes. And that's why when you're a financial type and you see all these journal entries that go through to correct past mistakes, you really get concerned. Something's wrong. When we try to come up with inventory, and Ron, you're an expert on inventories from your past experience, you got to be right. And when you do your counts and you do your checks, those numbers ought to be right. And if they're constantly changing, that's a big issue. You can hide a lot of sins in accounting for inventories.
Yeah, you're absolutely right. But boy, if you happen to be reselling some of that inventory, and you rebuy the wrong thing because your stock out report was wrong, now you've taken something that you didn't need and you bought more of it. You can't sell it. You just created a loss, immediate loss, simply by having the wrong information. That's a big deal.
Yeah, it impacts everything. And I think the most important thing, it impacts future decision making, and that's the area that's really going to drive the results of your company. So if you got the wrong information, you're going to make the wrong decisions, and it's going to have a negative impact on your company. Number 7 is, no matter which book you read about adding value, it all comes down to accountability. Who's accountable for what? And you need accountability. It's a cornerstone for process improvement. And if there's a problem, you need to know who made it, and you need to help them get back on target, so that they take responsibility and do what they're supposed to do. If there's no accountability in a business, then you're missing out on a lot of potential bottom line improvements. When people do audits, and I've been trained in this area to do audits, the first thing any audit book will tell you to do is look at the controls. The better the controls, the less testing you need to do to make sure that the numbers are presented accurately. So it's a very important aspect on the financial reporting side. And you really need to make sure you're focusing some time on it. And I would say that, and I have to ask Ray, how much in your experience, Ray, in dealing with your clients, do they really understand and talk about internal controls?
I have to say that it's been very seldom that people speak about it in a meaningful way. I don't think they really understand. It's not that they wouldn't want to, but I think we've all discovered, the smaller the business, the less they understand about what has to be done and how it has to be done. And I think one of the things that is really positive about micro giants, I think it enables people who are thinking about entrepreneurial positions or starting a business. If they listen and watch closely, they can learn a lot about these things that many companies don't even understand. Owners are not necessarily, they're usually technicians. They're good at one thing, but they're certainly not good at running a business.
Absolutely. And controls are an important part of running a business. And
yes.
The last point on controls is controls have to be cost effective. So it doesn't make any sense to spend $100 of controls to save $1 of potential risk. So they have to be cost effective. And that's another premise and assumption on controls that businesses need to keep in mind. How important are controls? Well, I don't know if you guys have heard of the organization COSO. It's 5 different audit organizations that got together to develop an integrated framework for assessing risks and controls. It's a big deal. When you have situations like Enron happen, and which created significant fraud, people need to find out what they need to do on the control side to make sure that it doesn't happen again, and activity is properly controlled in an operation. And obviously COSO is an integrated framework for big companies and government. And I've been involved with doing COSO audits on internal controls for government as well as for regular businesses. And because everybody wants to make sure that things are happening the way they're supposed to be happening and there's no surprises. So this organization has become an international organization. I had to spend probably 3 or 4 weeks of study and classwork, and then I had to pass a very rigorous test from the AICPA to be certified as an internal control expert. And I don't really use it much, but I probably should, because once again, it's more than just a financial concept. It's a concept that you need to properly run your business and make it more efficient and increase value.
I think one of the things that I was thinking as you were saying that, Ed, because of people's lack of understanding of internal controls and what it means, I think this kind of education would be exceptionally valuable to them, because it doesn't have to be expensive. Is that correct?
No, it doesn't. It's cost effective. You put in controls that are cost effective. You don't go out and spend more money on controls than you're going to be realizing benefits.
Right.
Yeah, there's a lot of things that need to be done that don't cost a lot of money, but it's just basically having people pay attention to what's going on. So
I would say it's probably the reason it's not done, if you know about it and the benefits of it, it's probably not done because it requires a lot of discipline to do it in a timely fashion, continually do it. And there are as we all know, there are an awful lot of small businesses where the owner is, not normally predisposed to discipline themselves. They tend to jump around and do all the creative things that created the business and allowed it to exist, and then they really get bored with doing repetitive tasks over and over again, and that's kind of what this is.
Yeah, that's true. So that would mean that to really have a good operation, you need a strong financial type in your operation that does take the time to focus on controls.
Yeah. A very, very detail oriented person.
Yeah, very detail oriented and a lot of communication.
Yeah.
So COSO, they came up with this internal control cube. And it kind of gives you an idea of the complexities of how complicated controls can be. But basically, they have 3 control objectives, and that is operations. And that's kind of the area that we spend the most of our time. And then you have reporting of financial information. And then you have the compliance with all the regulations that are out there. And all 3 of those are very, very important to make sure that things are going correctly. And then on the right side of the cube, you see the 3 entity levels. You have the entity level, you have the division, you have the operating unit. Obviously, that doesn't apply to a lot of the small businesses that we deal with, but for big organizations, that's very relevant. But the key 5 areas of internal control are control environment, risk assessment, control activities, information and communication, and then monitoring activities. So it all starts at the top with the control environment, which means people at the top care about controls and are focusing on them and making sure that they're operating the way they're supposed to operate to minimize risk in the company. So that's really one of the most important concepts of internal control, because if people at the top don't care, you can have the best controls below that level and it ain't going to make any difference. So that is the starting point. And once you really have that, the top, you have your board, you have your owners, and you have management, all excited or focusing on internal control environment and making it a meaningful existence. And it is a responsibility of management to put together a control environment, by the way. That's the first step. And then you get into risk assessment. That's an interactive process for assessing risks to achieve objectives. Control activities are the actual checks and balances you have built into your processes to make sure that any type of a material error is going to be identified in a timely manner. And information and communication, this is the one area that's really becoming more and more important in the digital age. Being able to communicate and having IT controls in place. So when there's a problem, it's automatically being reported. But the communication that gets right back to, if there's a problem, you got to deal with it. You got to communicate it to everybody. You got to analyze it. You got to take corrective action, and you have to improve the control so it doesn't happen again. And then the ongoing evaluations, the monitoring of activities is extremely important. And so there's five big areas of controls, and there's 17 principles that you audit of those controls. So as the control environment, you look at this slide and you see you have commitment to integrity and ethical values. That's one principle. board oversees controls independent of management because you're trying to keep management accountable. Appropriate authority and responsibilities are established. Track and develop and retain competent employees. We've had several shows on that. That's all part of the control environment, and hold people accountable for their actions. Just briefly wanted to go ahead and ask some questions now, but I do want to just briefly go through these 17 principles. And in addition to the 17 principles, there's like 90 some action items below that. So you can see it gets very complicated very quickly. Go ahead, Ray.
No, I was just going to say, I think, one of the things that we've talked about is the importance of culture. And, I don't know whether you guys have seen this, but, when it comes to ethics and things like that, I've seen organizations in which the owner is not doing the right thing, which kind of sends a bad message to his staff and creates a lot of the internal control problems that they see in his behavior. Have you guys experienced that?
Oh yeah, absolutely. And in the retail business, there is an almost accepted practice of taking cash out of the till, so you have unreported income that goes into the owner's pocket. It doesn't take very long for people to figure out what's happening there.
Right.
And if only the owner gets to check out, if the owner is trying to make sure that nobody watches what he does when he's balancing the cash register, the processes are kind of secretive and so forth. Sooner or later, people can figure out that something's going on, and
right.
Then that just opens up. It's like, well, he's taking a few bucks out. He's probably not going to mention, or he's not going to miss the extra $20 that I took and my buddy took. So pretty soon you've got 10-15% of your revenue is really not there, not being reported to IRS. And I think that there is as much as I will and I will continue to talk about being overly taxed. Part of being overly taxed causes people to want to cheat in some way. And then that gets us back to this whole controls issue. If you don't have the right information, you can't have you can't make good decisions. So many times, I worked in the retail industries for many years, and so much of the time, we'd go through the reports and they'd say, "Oh, but that's not really true. We really did more than that, more business than that." I'm going, "Well, what do you mean you did more business than that? You reported this amount of business." "Oh, well, we don't tell the IRS everything." And I'm going, "Well, but so how do you know?" "I correct yours." "Well, what do you mean you correct it?" "Oh, I figured I took $10,000 out of this particular category, or I took $10,000 out last month, and so I reported 100,000 in sales. But what I did is I put it back into this category because that's where we do most of our business." So I'm going, you're saying you just dumped in $7,000 or $8,000 or $9,000 into a specific category, and you reported that to me as an inventory item? It's like, how in the world we're trying to make projections for you so you can buy the right amount of stuff in the right season, and now you're telling me you're just guessing how much of that was in business? Do you see the problem here? And so why are you paying me? Well, this just it goes and it goes and it goes. It gets worse and worse and worse. You get deeper and deeper and deeper, and you wonder, well, no wonder you can't make a decent decision, because you're lying to yourself about how much revenue you have, and you think you can keep track of it, but you can't keep track of it across inventory. It says you can't keep the costs properly allocated, and so you end up having everything wrong. The whole business is just wrong because of a simple thing like that, which and for our government listeners, if we taxed less, people would be more honest about reporting their revenue. So it goes both ways here.
And to your point, Ron, you know, obviously the employees, if it's a small retail store, if they've got 6 or 7 employees, they know that. And so that gives, well, if the boss is doing it, he's not going to miss, like you
Yeah.
said, $20 out.
Yeah. Exactly right. And then you have this whole culture of dishonesty,
Right.
which starts as Ed mentioned. You know, it starts at the top.
Yeah.
Well, if it never starts at the top, and in fact there's a culture of dishonesty, even though it might be directed to, say, the government, if there's a culture of dishonesty, you're going to have a whole culture all the way through, and people are going to be ripping you off anyway. So you'll lose way more to employees than you ever save from the government.
Yeah, absolutely.
So every business needs a strong financial person. And it can be a part-time role, it could be a full-time role, but it's the person that has the responsibility to tell the owner, you can't do that. That's not right. We need reliable financial statements. We can't be taking money out of the till. We have to run this company as a professional organization. And you're trained to do that. You take a lot of classes to get your degree, then you have to pass tests, and and if you're a CPA, you're certified. So you don't want certified people aren't going to give up their career and take the risk of a business owner doing the wrong activity to reduce his taxes or whatever. That's a responsibility that you're a professional that you want to maintain. And that's where the rub is all the time. And that's why you really need a really good financial person to be able to keep everything moving in the right direction with the checks and balances, so that you don't have problems with the IRS, you don't have problems with your banks, because if you start doing things the wrong way, it's gonna cause you a major problem down the road. So we've worked at companies that all they want to do is they don't want to pay any taxes.
Right.
Well, I'm telling you, it ain't worth the risk to do illegal stuff to your tax return to save a few bucks, because they will eventually come to make a visit, and then you're in big trouble. And the first thing the business owner is going to say, well, it was my financial guy.
Yeah.
They're going to push the blame right on the financial person. That's why financial people have to, at times, they have to disengage, and they have to perhaps leave the company because it's incompatible to their culture and what's important to them.
Well, I think I was going to add a question and maybe a statement is that, you know, you were talking about, you know, most organizations have a CPA, but that guy only gets involved once a year. Part of what I think we're recommending for small businesses is some intermediate sort of a person, whether it's a bookkeeper or a part-time CFO, who can kind of fill that role. Is that kind of what you're saying? So that, you know,
I think it's an absolute essential for any business to have a person like that. And it's the person that doesn't always give the good news, it gives the bad news. The revenue guy wants to show that revenue is growing, like Ron was saying, but if it's not growing the proper way, it needs to be corrected. And that's why a financial person's really valuable. A good one is willing to go up against the owner for the right principles. And most of the time you can come up with some type of an agreement and you move forward. I mean, most people want to do things the right way. But if you find someone who's definitely on a different page and wants to pay no taxes at all costs, you definitely don't want to be associated with that company any longer. You have to resign.
Yeah.
So these are 6, 7, 8, 9, 5 principles on risk assessment, which we do when we go into companies. We look at the risk of operating, and I think that's really important. So having outside consultants are also important, in my opinion, to keep the company moving in the right direction and identifying issues before they become a major problem. Control activities are put into place to mitigate risk. Key is to use technology whenever possible. In the past, there's been a lot of frauds with technology because people didn't understand and there was no checks and balances on the technology. But for the most part, technology is becoming a big asset to the control environment, and that will continue. And there's even technology out there right now that looks at the past and predicts the future, and anything that's out of kilter needs to be reviewed. That's a whole new different ball game, and the technology is beginning to really become relevant in running a business. And then don't forget the good old policies and procedures. And that's why policies and procedure manual is really important when you're selling a business, because it just identifies how you do your business. And then the information and communication is really important, is that your CPAs are talking to your attorneys, they're talking to your bookkeepers, they're talking to ownership. So everybody is on the same page, and everybody's above board with complete transparency. And when you have a problem, you have to deal with it. You don't hide it. And the last thing is the monitoring, and this is missed a lot of times. When Sarbanes-Oxley came into play after some of the big frauds that happened, and they require big companies to test their controls on a quarterly basis. And that's a really interesting concept. That never happened before. The auditors would test maybe once a year some of the controls that they're relying upon, but management was never responsible for testing the controls. So again, running a small business is a little bit more challenging. You have to make some time to make sure some of your key controls are operating like you think they are, because just because you put a control in today doesn't mean it's going to be operating correctly a year from now. So I kind of go back to our 7-step process here on trying to transfer a business at the highest price with the reduced risk. And I think internal controls probably are part of the blue part. They're one of the fundamental concepts that keep everything else going and are really important to running a business. And I'm thinking maybe we should be having this conversation with more people, small business owners, maybe part of education processes, perhaps even microgiants, so that they understand how important internal controls are. So any comments, gents?
Well, I would say first of all, this is a great presentation, excellent. I've never really seen it put together in such an organized fashion before, so congratulations on that. And yeah, the micro giants certainly need to have some exposure to this type of thing. So many of them are still working on the basics, like, where is my market and who is my customer? And so they haven't got enough revenue. And they would argue they haven't got enough revenue yet to really be concerned about the controls. But there are a few of them who have pretty substantial businesses and employees who have access to the till and that kind of thing. And this sort of overview, let me put it this way: the awareness is really key, and it has to be an integral part of what they pick up when they're in business school or for microgiants, or any small business person needs to be aware that these kinds of controls are really part of what I'll call a mature business. If you don't do this, you're not mature yet.
Yeah, and one of the observations I would make, Ed, is that, this is a very comprehensive, and again, I applaud you for doing this and agree with Ron. What might be meaningful is that, being able to lay out something and say, okay, if you're a business of this size, here's the controls you can put in place, and then, kind of leverage that, just like we have with the step ladder here, so that people understand, well, I can't afford this. And I think what I'm hearing you say, Ed, yes, I know it could be expensive, but we can do it very cost effectively because it's also always a part of your process anyway to monitor your financials. This is a way of just ensuring that those numbers are accurate. Is that fair?
Yeah, I think that's very fair. And I think the problem, I know a lot of businesses that have major problems with their business, and somebody come back to haunt them, some type of surprise, some type of a lawsuit. These types of controls help prevent that from happening. And it's really funny. A lot of times it happens to companies that are owned by financial professionals that just kind of sometimes forget about what they should be doing. And then they got a major problem down the road they have to deal with. You want to limit your surprises, and you don't want to have significant risk to your business that could possibly put you out of business down the road.
And let's not forget, and I think you're absolutely right, Ed. Let's not forget that a surprise can be a big one. You buy insurance so that when your tree falls over on your house, you don't have to stand the entire cost of replacing the tree and replacing your house at the same time. So, I mean, some of this stuff, it's a little bit like insurance. You don't want insurance if nothing happens, but boy, if it does, you're sure glad you do have it. People tend to have casualty insurance because they understand they need that. And there are all kinds of other risks that can pop up. We've mentioned 3 or 4 or 5 of them, but I'm sure that represents about 5% of the risks that are actually out there for small business that really can have a huge impact. And I'll tell you, they come in all kinds of ways. A recent one that happened, one of my clients has had a person come in and an employee come in and set them up for a fraud lawsuit. And literally, as they went back through this, and they said, gee, this guy's taking us to court because of, I guess, improper firing. He's saying that, which wasn't the case. I mean, this guy actually quit and walked away from the business, leaving them high and dry. But he had sort of collected some information, got inside the organization, became a trusted employee, and literally, it's apparent today that the whole purpose of his working for them, because they were sort of glad to have him, overqualified kind of person, the whole purpose of him going to work for them was to set him up for a lawsuit. Wow. So, there's a situation where you kind of go, gee, maybe we should have paid more attention. And in this particular case, we've talked so much about profiles. This person was hired against the recommendation of the profile. He did not fit the profile, but he seemed so great that they hired him in, and they needed employees. They hired him anyway. So you see, there is a case where if they lose that lawsuit, that's going to be $100,000-$200,000 hit for them. They likely won't, because they'll spend the required money now for their attorney. But had they done the right thing up front, they wouldn't have ever gotten to this point. Right. So there are those kinds of things that happen over and over and over again, where the cost is a whole lot. You just don't know about it yet. So sometimes looking at the cost of controls could seem high, but it's not as high as it could be.
No, that's why I've often said that organizations usually hire what they can afford, but they never get what they need.
Yeah.
That's a good phrase. Yeah, that's a very good phrase. I should put that in the presentation.
Yeah.
That's a very good phrase. That's very true.
Well, thank you, guys. Is there anything else, or this was such a good presentation? I'm sure it's, in my mind, it spawned some other things. We could go into more detail as we move forward, but I want to thank you, Ed. It was, it certainly illuminated a lot of my understanding.
Well, thank you guys for your relevant comments and conversation and discussion.